Hello and welcome to CNBC-TV18 Mumbai Newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh and you're watching Mutual Fund Corner. And today we are going to talk all about ELSS funds which recently saw a decline in the month of November. And earlier this year, the SEBI also allowed mutual funds to launch passively managed ELSS. So a lot to talk about, Pavitra, and of course it's the tax-saving instrument as well for a lot of investors. So let's get going.
Let's get going. And to discuss all of this, we have a guest joining us who's going to be taking us through all of our queries. Vineet Nanda, Managing Director at Sift Capital, joins us now. Vineet, good afternoon and thank you very much for being on the show today and taking out the time for this show. And I'm going to get straight to it. Sonal was just mentioning that there has been a decline in this category in ELSS funds in the month gone by. Do you think there's some kind of structural change that is playing out that we are seeing in this category? Or do you think this is perhaps just a one-off and you can expect sort of flows to pick up once again in the next quarter?
Good afternoon, Pavitra and Sonal. Thanks for having me on the show. See, the mutual fund industry as a whole crossed 40 lakh crores in November. This industry has grown from 8 trillion in 2012 to 40 trillion now. And if you look at data for November, specifically for the ELSS category, there was gross purchase of 1,650 crores. There was sales worth 1,900 crores. So the net outflow was only 250 crores. Considering that the ELSS category has more than 1.55 lakh crores invested, the outflow was basically not even a third decimal place. And if you look at other categories, so even let's say dividend yield or focus like C-cap and the pure large cap category also saw minor outflows. But the equity category as a whole had still positive inflows. So I think one can just look at this as an aberration, probably driven by a bit of profit taking which happened after we had a short rally in November. And my view is that as we get into the January to March quarter, which typically is the aggressive quarter for tax saving, these numbers would start looking up.
Okay, so you expect these numbers to start looking up and not a big outflow is what we've seen in the month of November. Can you give us a sense in that case as to how these ELSS funds have performed so far versus the benchmark, and how would you rate them in terms of performance?
So majority of the ELSS funds beat their benchmark when we look at long horizons. Because most of these are growth oriented and actively managed funds. So if you look at, let's say, even 3-year data as of today, 19 out of 30 funds have beaten their benchmarks. Now, when we look at shorter terms, the fact is that over the last 12 months, the markets have been extremely choppy and value stocks have done better than the growth stocks. So, the small cap index is down 4% over a 12-month period compared to the large and mid cap index, which is up by 10%. So therefore, in an environment where markets tend to be more concentrated and not broad-based, you have these aberrations which happen in terms of performance of funds vis-a-vis their benchmark. But in my view, over the next 12-24 months, as we get over the current volatility and the economic environment stabilizes, and as we have the leadership again moving to the growth stocks, you will see that the outperformance of the actively managed ELSS funds coming back into reckoning.
All right, we got that point, Vineet. Another thing that we want to discuss with you about ELSS schemes is that now there's been an introduction of passive ELSS schemes as well. What is your take on this? And do you think at this juncture the ELSS scheme which is active is preferred, or would you go for a passive? And if you could take us through, the advantages and disadvantages of these.
Sure. So see, India is an emerging market and there are enough opportunities for active fund managers to create value. As I shared, last 12 months, value stocks like NTPC, ONGC, Coal India have gone up. The PSU banks have rallied by nearly 24%, whereas growth stocks like IT, banking have kind of underperformed per se. Interestingly, out of the 5 stocks which have gone to the $1 trillion club in the last 12 months, so out of the 5 stocks, 2 of them are basically LIC and Coal India, which are again, in the PSU space per se. So my view is that the active managed funds will continue to outperform the index passive funds over a longer horizon. And even in 2019, we saw this phase after the ILFS crisis, wherein the market was very concentrated, and therefore actively managed funds largely outperformed the passive funds, and there was this large discussion at that point of time also. And this happens, the cycle of value beating growth happens every 3-4 years, not only in India, but in the global markets. So therefore, my view is that the active managed funds would continue to be preferred investment options, both for open-ended and ELSS funds, notwithstanding the short-term aberrations which happen. And the index funds or index ELSS funds would be an option for people who don't have advice to professional advisors and who basically don't want to make mistakes in making their choices.
Okay. All right. So that is the difference or the preference between active and passive ELSS funds, very well defined by you. So let me go across to the next query, and that is for a very recent fund that has been introduced, IIFL ELSS Tax Saver Index Fund. You briefly spoke about it, who it is for, but generally the NFO scheme is open and will close for subscription on 21st. Can you take us through what it is and who should go for it in more detailed manner?
Sure. So, see, typically ELSS investments are done by people largely for tax saving purpose. And the intent also is that, compared to the other tax saving options which are there, which is, public provident fund, 5-year corporate FD, national savings certificate. The idea is that ELSS fund is superior because it offers the lowest lock-in period, because most of the products have a 5 to 15-year kind of a lock-in period. At the same time, these funds are able to generate superior returns over the 3 to 5 year horizon, which is what people can expect to lock in their money if they were to go for any alternate instrument per se. Now, if you look at, historically over a 5-year horizon, these returns are always kind of superior to most other options, which are all largely fixed income or debt oriented per se. So hence, the idea is first of ELSS fund being a superior option. Now, in terms of, what is the category of investors who should or who can opt for the current NFO from IIFL, which is a index-based ELSS fund. So people who want to take exposure to the ELSS category, but do not, have access to professional advice, but still want to participate in the growth opportunities which are there in the Indian market, can invest at a retail level into the current NFO. So the current NFO is a Nifty 50 NFO, which will invest in the top 50 stocks which are there in the Indian stock market, and hence would be able to get a broad-based exposure to the Indian economy and participate in the growth which is going to be there as India moves towards the 5 trillion benchmark.
Okay, we get that point, and this is on the ILSS Nifty ELSS fund, which has been launched, and making the case for who it really works for right now. Vineet, just one question, since we are talking about passively managed funds as well, what is, have you sort of noticed any changes ever since these have been allowed, and within the industry, what do you think the view is on this category of funds, on passively launched ELSS schemes?
Sure. See, the Indian market is evolving, and I think there is space for multiple investment strategies which are there. So my view is that it is not that we're going to be restricted to only active and passive managed funds. Probably over a period of time, you will have maybe quant-based funds coming in this category. If the regulations allow, you could have strategies which could allow derivatives, etc. So I think we are still in a very evolving stage, and opportunities for multiple investment strategies, multiple for, actively managed, passively managed, index funds. In fact, within that, this is probably an option which is there in the Nifty 50 index-based fund. You could have options coming in the Nifty Next 50. You could have Nifty 100, Nifty 500. So, based on different benchmarks, you could have different passive funds also getting launched over the period of time. Also, also probably as the fund size increases over the next, 5-10 years, the role of passive funds can potentially increase. And I think one role or one aim which many fund houses are trying to achieve is also trying to create a track record over the next 3-5 years with their launches, so that when the market kind of grows large enough and there is greater opportunity for passives, then they are well positioned because they will have a track record to be able to show to the investors.
Okay, all right. So, Vineet, we'll just do one thing. Please hold on. We'll take a quick break, and on the other side, we'll continue our discussion on ELSS funds, and we'll take up some queries as well. Stay tuned.
Hey guys, welcome back. You're still tuned into Mutual Fund Corner, and we still have Vineet Nanda of Sift Capital with us to take us through everything that we have to discuss on ELSS funds. Vineet, a query that comes to us very often whenever we ask people, our viewers, on what kinds of queries they have related to mutual funds, is that we all know that there's a 3-year lock-in period for this category. But what do you do once it gets over? Do you think that your investments should be redeemed immediately, and should you reinvest in other funds, or should you just let it be?
See, equity investments, in my view, 3-year is purely a regulatory lock-in. But ideally, from a wealth creation perspective, people should be looking at putting money into equities with a 10-20-year horizon. And therefore, once you have chosen a good fund, even after your lock-in is over, you should continue to hold the fund unless you need money for any of your financial goals. And the purpose of that investment should not be limited to only doing a tax saving and holding for 3 years. But ideally, as you continue to hold, it will create a multiplier impact and also help you in meeting your financial goals, which are, even 10-15 years down the line. The review process of your holding should be done like you will do for any other open-ended fund. And therefore, you should look at redeeming and reinvesting only in case you believe that the future performance parameters of the fund are not going to deliver returns in line with what your expectations are. And otherwise, just keep on holding it.
Okay, so keep on holding if you meet the certain criteria you just spoke about. So that's about people who should keep holding ELSS funds. According to you, who should not invest in an ELSS scheme?
So what's important to understand is that the underlying portfolio of a ELSS fund are basically equities. And hence, equities will come with volatility. They will come with uncertainty as far as returns are concerned per se. So investors who are looking at a scenario where market news and noise impacts their peace of mind, investors for whom stable and fixed returns are important should avoid investing into ELSS funds and should stick to the more traditional saving instruments like PPF and NSE or 5-year fixed deposits per se. Also, ELSS funds can be a good investment vehicle itself outside the tax benefit. But people who have, a financial goal, which is, within the next 5 years, and who do not want a situation that their money gets locked in, should avoid investing into ELSS funds.
Okay, you have actually answered part of my next question, which is that, what are the key risks associated with an ELSS fund? And of course, liquidity could be a big factor for a lot of investors. Also, Vineet, how much do you think of your total investment should be invested in this segment? Again, we know that this would be different based on your own investment goals. But if you could take us through some kind of contribution that maybe you should give to ELSS out of a full portfolio.
Sure. See, the advantage of a ELSS fund from a fund manager perspective is that the fund manager doesn't have to deal with lumpy inflows or outflows. So typically, from a category perspective, this is the category where the money is more sticky, and therefore it allows the fund manager to really invest with a longer term horizon without worrying about short term flows based on market dynamics. And as I shared, that one can look at this category as an investment category also. So though how much of it should be allocated will be a function of individual liquidity requirement, would depend upon how far your financial goals are. But in my view, 10 to 15% of your assets can be invested into an ELSS fund in pursuit of better returns per se. And worst case, even if there is an exigency, the fact is that you'll still have more than 80% of your money liquid and available to you at any point of time.
Okay, so 10 to 15% is what is a possible allocation that can be made to ELSS funds. Of course, depends from investor to investor. But just generic questions, Vineet, on ELSS itself, because most ELSS investments are done in lump sum fashion. So does that really matter versus SIP route, since the money is anyway locked in for 3 years?
See, the purpose of SIP is actually creating more financial discipline per se, and capturing the market volatility. Also, the SIP route then plays into the broad discipline that an investor is having. So let's assume an investor is investing 100 rupees. So if out of that, let's say 12.5 rupees per month essentially goes automatically into a ELSS fund, the tax saving happens automatically. Also, from a perspective of an investor, he doesn't miss out accidentally of not doing the tax saving investment for the year, and it happens in a systematic manner. At the same time, it helps in capturing the market volatility and can create superior returns compared to people trying to time the markets and doing a lump sum manner.
All right, that point is definitely well taken. Vineet, the next question we want to ask is on debt-linked savings schemes, because there's been so much conversation around this. It has been a long pending request of the industry. So A, what are your thoughts on this? And secondly, the fact that this has not been approved yet, it's not come through. Do you think that this signals a thrust to the new tax regime? And in that context, what would your thoughts be on the future of ELSS as well?
So I think ELSS as a category will continue to grow. And as I shared that multiple investment strategies will also come in. So the request from the industry has been there to allow debt-based ELSS funds. They haven't found favor yet, but my view is that as the new tax kind of regime comes into play and there is some kind of alignment between taxation from capital gains across different asset classes, including real estate, debt, equity. And maybe as the clarity comes, hopefully over a period of time, debt-based ELSS funds should find favor with the regulator. And, we could have, again, like hybrid and debt-oriented. So you could have multiple categories coming into this. And like investors are able to make choices in the open-ended space, and today investors are able to make choice even in NPS for that matter between, let's say, debt and equity. Similarly, I believe that choices should be allowed in the ELSS category also, so that depending upon the time horizon of the investor, depending upon their risk appetite, they're able to take the right choices.
Okay, all right. So that is about a possibility that yes, a debt-linked savings scheme could be there. There's been a long pending request from the industry, but as you say, ELSS as a category will continue to grow. Before we let you go, Vineet, and I don't know if you will be able to answer that for us, but I'm just still trying. There are a lot of ELSS funds available in the industry as well, while we are seeing that so far, as you said, they have been able to beat the benchmark rates or benchmark returns as well. Which one do you think is the right pick for an investor with, say, an investment horizon for 5 to 6 years? Anything that you would like to advise the viewers or the investors who are watching us?
Sure. So I think at this stage, as I shared, because the rally in the markets has been very, very narrow, if someone is taking exposure today, I think it's important to focus on tax saving funds which are investing in the broader markets and therefore are positioning yourself for superior returns over a 3-year period. And in that context, I would recommend, Canara Robeco Equity Tax Saver, the Tata India Tax Saving Fund, the SBI Long-Term Equity Fund, the Bank of India Tax Advantage Fund, and people who have a bit of aggressive appetite can even look at the Quant tax plan.
Right, those are some of the recommendations from this ELSS category. Vineet, on that note, we're going to thank you. Thank you very much for taking out the time and speaking to us about this complete explainer on ELSS funds. On that note, from Sonal and me, thank you very much for tuning into MF Corner. And you guys stay tuned. Closing bell will come up next to take you through the last hour of trade.